coming at you at the Bayntree office here in Scottsdale, and I've got my trusted colleague Ruby with me today. And as you can see, she looks a little sad, a little depressed, and part of that is because of the market volatility that we've seen to the start of this year. So I wanted to go through a couple things with Ruby and a couple takeaways that you can utilize to make sure that you keep your emotions at bay. So first and foremost, what's been happening? 21 was a pretty calm year in the overall markets. Part of that was really because the Fed has been very accommodative in regards to their overall monetary policy since the start of the pandemic. Think of it as easy money, low interest rates, and what that did, yes, risk assets had banner year, real estate, industrial, hard assets have been through the roof, oil and gas, etc. But what we saw is that inflation last year reared its ugly head, and inflation is most we've seen in decades. Most of us have never really experienced inflation in our lifetime. So the Fed has come to the table and says, we need to address that. So the two things that they're going to do this year, which has caused the markets to reprice, is raise rates 2 to 4 times most likely, and pull money out of the system by not buying treasuries and bonds. Right now they've been spending 60, 80, and back in the day it was over 100 billion a month buying these assets, meaning taking money out and putting it into the system. So now if they reduce that or eliminate it to zero, it means less money that's in the system, which means that assets have to get repriced. Think of it, growth stocks, which had a banner few years, as interest rates rise, they're not as valuable. That long-term growth, the markets aren't going to pay for that high valuation. So we're starting to see adjustments. Maybe there's potential in value, in small cap, in certain fixed income. So one thing we have to do more than anything, we don't know what the Fed is fully going to do. We don't know if they're doing this in a time where the markets, the overall economic activity is slowing. There's been times in the past that the Fed has done this, and they've done it right in the beginning of a recession. Now, we're not saying, Ruby, a recession is happening right now, but these are all things that we've got to be careful in. So what can we do in an environment like this? Well, first and foremost, keep your head. Don't let emotions get the best of you. Have a financial planning team that is there to help, a lot of times act as a steward, a psychologist, so that you stick to your plan. The last thing you want to do as a retail investor is sell at the wrong time. When are you going to get back in? So an overall financial plan is about things we can control. And it's not just about the investments, Ruby. It's about being efficient and proactive on taxes. It's about making sure your estate plan is in order. It's so many things behind the scenes, and that's something that really the value, if you're working with a planning team, it's not so much just the investments, that's a piece of it, but overall we want to bring all those pieces together so no matter where you are, whether you're working, you're retired, you are going to be able to withstand periods like this that are volatile, and that you're not going to go make some major changes to the plan. If you have any questions, you can email us, leave some notes in the comments below, and we'll be sure to get back to you. Ruby, what do we say? Happy planning, everybody.